Have you also seen stories like these after the budget? So then you might be wondering, why are companies rushing to buy back shares? Well, because of the tax tweaks made in this budget, which comes into effect from October 1, 2024. So without any further ado, we deep dive into understanding how this share buyback rule will change and impact you and the India Inc. Let's understand. First, let's find out what the concept of share buyback means and why do companies do this. A share buyback is when a company buys its own shares from the market, which reduces the number of outstanding shares, which then increases the value of the remaining shares. Companies buy back shares for various reasons, including returning profits to investors, improving financial ratios, consolidating voting rights, and more. Now coming to why so many companies are announcing share buybacks. So from October 1 this year, there will be significant changes to the share buyback tax regime in India. The new rules will shift the tax burden of the share buyback from companies to shareholders. Now the key changes include: number one, current 20% tax on buybacks paid by the companies will be eliminated, and the shareholders will be taxed on buyback proceeds as dividend income according to their tax slabs. Number two, companies will deduct a TDS on buyback proceeds at a rate of 10% for resident individuals and 20% for NRIs. Number three, the cost of shares bought back can be claimed as capital loss and can be offsetted with other share sales. Now what this will do is that it will increase the tax burden on the shareholders, especially the small retail investors. In simple terms, before budget 2024, if the company buys its own shares back, it pays the tax and the amount that shareholders got was tax-free. So here gains were made by the investors, but company paid the tax. Now from October 2024, the buyback amount that the shareholders get will be taxed in the hands of the shareholders because it is a form of dividend. Now the purchase cost of the shares bought back by the company will be treated as the capital loss, which can be offsetted with other capital gains made. Now let's understand this with an example, how NRIs and resident Indians are taxed under this new rule. Let's say there are two people, Sita, a resident Indian, and Geeta, a non-resident. Both receive 100 rupees from a share buyback. Now under the old system, the company paid a buyback tax of 20%, reducing the net amount received by shareholders to around 79 rupees. Now under the new system, Sita will be taxed on the entire 100 rupees as dividend income at her applicable tax slab. Assuming Sita is well paid in her job and is in the 30% tax slab, then her rate will be around 35.88%, leaving her with approximately 64 rupees. Meanwhile, Geeta's 100 rupees will also be taxed as dividend at the rate of 20%, assuming no tax treaty benefits, leaving her with approximately 80 rupees, which further Geeta can claim beneficial rates under an applicable tax treaty depending on the country of her residence. Here, you also need to consider that there is a TDS that the company deducts, and the shareholders can offset the cost of bought back shares against the capital gains. Now, why is it not beneficial for small retail investors? Let me explain this with another example. Say Jaya is an investor with lower capital gains and Sushma is an investor with higher capital gains. Both had shares of a company X and a company Y. Jaya purchased 90,000 rupees worth shares in both X and Y, and Sushma purchased 90,000 worth shares in X and 2,15,000 worth shares in Y, a little more than Jaya. Now company X announced a buyback during this year and the buyback price was 1 lakh rupees. Further, Jaya and Sushma sold shares of company Y. Jaya sold it for 1,80,000 rupees and Sushma sold it for 4,30,000 rupees. Now calculating the total profit for both, for Jaya from her investment in X and Y was 1 lakh rupees, and for Sushma it was 2.25 lakh rupees. Now let's calculate the tax. For company X shares, Jaya and Sushma's capital loss is at 90,000 rupees, which is sale price minus the purchase price. For company Y, for Jaya the capital gain is 90,000 rupees, and for Sushma the capital gain is 2,15,000 rupees. Now since the entire buyback is considered as dividend income for both, the dividend income is 1 lakh rupees. Now the LTCG for Jaya will be nil, and for Sushma it will be 1.25 lakh rupees. Exemption on LTCG is 1.25 lakh rupees as per the new rules. So LTCG for both is now 0, considering no education cess and surcharge. But tax on dividend income is 30%, assuming that the tax slab is 30% for both, which is 30,000 for both. Now when you compare the pre-tax profit, Jaya is paying 30% as tax liability of her profit, but Sushma is paying only 13.3% of the profit as tax. So now here the smaller investors are losing. Now while the new rule makes sense that the shareholders should be taxed for the profits they receive, experts say that it would be better if it was taxed as LTCG instead of dividend for at least the retail investors. Here the winners are the tax authorities, who will get more tax revenue, tax exempt mutual funds that may gain popularity, and non-resident shareholders with tax treaties. Losers are high income resident shareholders whose tax burden is going to be increased, and the corporates, as they won't be able to use buyback as primary capital return method, as the proceeds are now taxed in the hands of the shareholders. I hope you understood the math, and for more such news and views, keep watching ET Now.
If you like this video, then like, share and subscribe to ET Now.